There's a saying in health policy that today's solutions are tomorrow's problems. And this is certainly the case in health insurance. As medical technology became more and more expensive and more people were insured, healthcare costs started to skyrocket. It's not a simple story as to why, but suffice it to say that there were a lot of attempts to think hard about ways to control this cost. And one of the solutions that evolved actually in the early part of the century but became really popular in the 80s and 90s in the United States is managed care. So this was, in theory, an attempt to improve quality and cost at the same time. The key elements of managed care are three. First, you have provider contracts. So you have these insurance companies contracting with providers, either hiring them outright as salaried employees or getting a group of providers together and getting them to agree to take a reduced amount of payment in order for a guaranteed stream of patients. The second component is bundling of payments. And one common way to do this is capitation. If you want to shift some of the risk onto the providers and you're the insurance company, it makes sense to pay them a flat rate per person per month, let them assume responsibility for the care, and that way if the provider runs up a higher cost of care, it doesn't cost the insurer more. So this is thought to be a way to disincentivize unnecessary care and encourage care that's more preventive. And finally, there's gatekeeping. And this is a way to control access to specialists so that instead of allowing patients to go to self-refer to specialists, they have to get a referral from their primary care doctor. And this is a common element of a lot of managed care. So we're going to talk about three different kinds of health insurance products that have varying degrees of managed care. So a health maintenance organization, this is sort of classic managed care. With an HMO, patients are restricted to a certain network of providers as a way to keep costs down. Remember, these are providers with whom the insurance company has negotiated reduced rates. There is often a strong gatekeeping requirement. People have to have primary care doctors to see a specialist. Premiums tend to be fairly moderate compared to other types of insurance. There's often a very low out-of-pocket expense. Most typically this would be a co-payment to see your provider. Remember the flat fee. And there is a cap on out-of-pocket expenses. As you can imagine, this is kind of restrictive if you have to see only a certain subset of providers. So something that evolved in response to dissatisfaction with this model was the preferred provider organization or point of service plan. They mean essentially the same thing. And so what you have is basically an HMO with an option to opt out of the HMO. So if you stay within your network of providers, you pay lower out-of-pocket costs. If you decide to go to other providers, you can do that, but you're going to get a reduced benefit. There's still often a gatekeeper requirement, at least within the network. You tend to pay a little bit more for the privilege of opting out of the network in terms of premiums. And again, the out-of-pocket cost can be high for the out-of-network component. But in general, taken all together, the out-of-pocket costs are low to medium, depending on how you decide to use your benefits, whether in-network or out-of-network. And then there is also a cap on out-of-pocket expenses. Finally, something that's becoming more and more common in just the last few years is something called a high-deductible health plan, coupled with a health savings account. So the way this works, a high-deductible health plan is a bare-bones insurance policy with a very high deductible that is essentially there to protect you from catastrophic healthcare expenses. You're not restricted to a particular network of providers. There's usually no gatekeeping requirement. These are very cheap because, again, you have a very high deductible and a lot of people will never hit that deductible. The out-of-pocket expenses, though, when you go to access care, can be quite high. Now, part of the way to deal with this is the second component of this, the HSA, or the health savings account. So you're given a checkings account, essentially, that can be taken out of your wages directly before taxes in a lot of cases. and you're allowed to spend this on any healthcare expense. Sometimes employers will even fund these accounts partially for the patients. This appeals to economists in that it really puts patients' skin in the game, and that they have their own money at stake in making these care decisions. However, that lies on the assumption that patients are going to make the best decisions in terms of when to access care and when not to, based on these fairly strong financial incentives. There is a cap on out-of-pocket expense, and I put that there to emphasize that with all of these, there are protections, there are out-of-pocket maximums when the costs do go to zero. So there are two ways to get private health insurance. As an individual, you can purchase a policy directly from the insurance company, or the more common way in the United States is a group policy. So employers buy these policies to cover their employees, and then employees can choose to participate, and they pay for a share of their premiums. Either way, individual or group, you could purchase an HMO, PPO, POS, or high deductible health plan coverage.